On the rise. Your monthly market commentator for March 2023. Global markets. Markets started on a rocky note in March with concerns over a banking system collapse. However, most major assets ended the month on a positive note. The S&P 500 ended the month up 3.5%, the MSCI World Index and MSCI Europe ended the month up 3.2% and 2.5% respectively, and the MSCI Emerging Markets ended the month up 3.1% in US dollars. US equities sold off, and oil prices fell in the beginning of March following the collapse of Silicon Valley Bank. The market had feared that there would be a contagion throughout the banking system. However, the US Federal Reserve responded swiftly to calm the market and improve sentiment toward the end of the month. Over the quarter, UK equities underperformed global equities, and European stocks outperformed global equities. The US Consumer Price Index increased by 0.4% in February, putting the annual inflation rate at 6%, which was in line with expectations. The inflation rate is still above the Fed's target of 2%. As expected, the Fed announced another 0.25% interest rate hike, taking the interest rate to the highest it has been since 2007. The US dollar weakened on expectations that the deteriorating economic outlook will result in the Fed cutting rates in the second half of the year. Inflation in the UK increased to 10.4% year-on-year in February, and the Bank of England hiked interest rates by 0.25%. Growth in Europe proved to be more resilient than expected, and despite inflation declining from 8.6% in January to 8.5% in February, the European Central Bank hiked rates by 0.5%. Emerging markets. Emerging markets outperformed their developed counterparts in March, with the MSCI Emerging Markets and MSCI China indices delivering 3.1% and 4.5%, respectively. The China Manufacturing PMI, or Purchasing Managers Index, as a gauge for production efficiency, remained upbeat at 51.9 in March, following 52.6 the previous month. Commodities. In the past month, the Bloomberg Commodities Index experienced a decline of 0.21%. However, industrial metals demonstrated a positive trend, likely due to the anticipated growth of economic activity in China. Gold prices rose due to a surge in safe haven demand, caused by the recent banking sector instability and the expectation that the Federal Reserve would reduce the pace of its interest rate hikes. Local markets. In March, South African equities experienced a decline as a result of several negative factors. The country's economic growth outlook was particularly impacted by the South African Reserve Bank's larger-than-expected interest rate hike, higher inflation rates, and ongoing power outages. As a result, the FTSE/JSE All-Share Index and capped SWIX fell by 1.3% and 2%, respectively, with financials taking a particularly hard hit and falling by 6.2%, while industrials were down 0.8%. Despite this, resources were the only sector to see an increase, rising by 2.8%. The JSE All Bond Index experienced a gain of 1.3%. Q1 2023 performance. During Q1 2023, the FTSE/JSE All-Share Index and capped SWIX experienced gains of 5.2% and 2.4% respectively. The industrial sector saw a significant surge of 13.6%, whereas the financial sector experienced a decline of 0.3% and the resources sector ended the quarter with a 4.7% decrease. The JSE All Bond Index gained 3.4%, while listed property suffered a loss of 4.8%. Cash, as measured by the STEFI Composite Index, performed positively with a return of 1.7%. SARB hikes with a surprising 0.5% interest rate hike. South African Reserve Bank Governor Lesetja Kganyago surprised markets by raising interest rates by 50 basis points. This decision has pushed the repo rate to 7.75%, leading to the prime lending rate soaring to 11.25%, marking the highest it has been since 2009. After the announcement, the rand reacted positively, appreciating 3.1% against the greenback. Market predictions expected a more moderate increase of 25 basis points. However, the aggressive hike was deemed necessary due to the rapid depreciation of the rand and persistent inflation concerns. Transaction capital plummets 60% in March. In March, the share price of Transaction Capital, the conglomerate that holds WeBuyCars and SA Taxi Vehicle Financing, experienced a significant drop of almost 60%. This was due to the company's announcement of restructuring its taxi business, which has been struggling to regain its pre-pandemic levels, resulting in a decline of 46% in earnings for the operation. Despite this, the CEO of the group, David Hurwitz, has assured investors that any defaults in one subsidiary will not lead to a breach in covenant clauses on another. Portfolio Manager Commentary. Markets continue to fight the idea that the Fed will maintain high interest rates, despite their repeated commitment to do so. Rather, equities rallied on the hope that cracks in the U.S. real estate markets and banking sector will force the Fed into more accommodative monetary policy. Once again, we find ourselves in the bizarre situation where markets rally on bad news with the belief that bad news will lead to more stimulus. While this has happened in the past, we believe the Fed's hands are now tied as they face a serious inflation problem. If left unchecked, inflation would be disastrous for the US economy. Fundamentally, the market environment remains unsupportive of equities, inflation remains elevated, growth is slowing, liquidity is declining, and geopolitical risks are high. As a result, we maintain a conservative positioning in our portfolios. Our exposure to global equities is low. Within equities, we have taken a more defensive stance, favoring US quality equities and defensive sectors. South African mid and small cap equities are particularly cheap but vulnerable to a global sell-off. One needs to carefully pick companies that can grow their earnings in a low-growth environment. Our portfolios have a high allocation to SA bonds, where longer-dated instruments are still offering double-digit yields, than exposure to commodity-backed loans. We also hold a lot of cash in our portfolios. We prefer ZAR over USD given stretched valuations, but are looking to increase our exposure to USD given the countercyclical nature of the dollar. Our large cash position gives us the dry powder we need to take advantage of bargains that may arise from market sell-offs. Finally, we have a position in renewable energy infrastructure projects, which are not only attractive from an IRR perspective but will meaningfully increase electricity production and reduce carbon emissions in South Africa. This concludes our March 2023 market commentary. Thank you very much for watching.